Hello, everyone. Thanks so much for joining us today. My name is Christina Credit. I am the Financial Wellness Program Manager here at Copper State Credit Union, broadcasting live here from our Operations Center. And I am with Ryan Graham. He is a financial advisor with Copper State Wealth Management. We are super excited to be here today and to chat with you all on investing, really a beginner's guide to investing, what you need to know in order to get started. But first, just to introduce Ryan. Ryan, how long have you been in the financial industry?
Yeah, 20 years this month. So very excited to be here and help our members learn a little bit more about investing with Copper State.
Well, happy anniversary month.
Thank you.
Yes. So yeah, that's awesome. That's a lot of experience. And of course, we'll share like your contact info at the end. But we want to spend the majority of our time today talking about investing. But I can't help it. I have to get at least one like embarrassing or fun fact from you so that everyone can take you really seriously. Hit me with it. What's a good fun fact about yourself?
Way to put me on the spot on that one. I broke my leg jumping out of a van, so I still get a lot of grief on that from family.
Wow, that's fun.
Yeah.
I mean, not fun at all, but
Yeah.
all right. Well, thanks for being a good sport, Ryan. And let's go ahead and jump in today. Thanks everyone for joining us. And really, if we're going to talk about investing and we're going to make that step and begin to do that, I think it's important to start with how to prepare yourself and to prepare your finances for investing. And a couple of the things that I just can't help but talk about as someone who's in financial education and in that world is emergency savings. So this is going to be a cash account. And when I say cash account, I mean you could access those funds right now if you needed to. So that means it's going to be in a credit union checking account, a credit union savings account. It's going to be a cash account where you build up to about, I don't know, Ryan, is it 3-ish to 12-ish months worth of savings? How do you really make that differentiation if you're someone who needs 3 months of emergency savings or 12 months?
Yeah, that's a great question. I think everybody's situation is different. So we really do look at it on an individual basis. The people that I find are maybe the 3 months of savings, maybe have a newer vehicle and are maybe renting, have a really secured source of income, maybe like retirement, Social Security, or just been at a job for a really long time. I think when we get into the more of the 12 months of expenses set aside, somebody that's, maybe got an older vehicle, owns a home that might have, things happen, air conditioners break, things like that. Also depending.
From personal experience, air conditioners do break.
Yep. And then, little things like, being in the construction industry, or obviously with the pandemic, we've seen a lot of industries like retail that have, people were out of work unexpectedly. So just really being able to save for those emergencies that could potentially come up.
Yeah, that makes sense. And just to clarify here, when we talk about living expenses, that's really going to be your basic absolute needs, right? So enough for food, enough for housing, enough for transportation, enough for utilities, and trying to build that up somewhere in between that 3 to 6 months or even up to 12 months. So if you've got that emergency savings covered, that is awesome. Another thing that we say is awesome to do when you're preparing to invest is work on setting up some mini savings goals. So we think of this as more short-term savings between 0 to 2 years, right? And what's going to be in here, it's going to be a cash account as well, like a checking or a savings account. But these things would be like saving up for the holidays, for example, saving up for a vacation, saving up for a car down payment, something where it's coming up relatively soon, but you're saving up for it in advance. People that take advantage of this mentality end up really appreciating that later on when they need it. And then the last thing we're going to go into today, just in the preparing side and the preparation side, is assessing your debt health. So a couple questions to ask yourself is, what types of debt do you hold and how much, right? Not all debt is bad, for example, but if you want to, like if you have significant high interest credit card debt, you know, if you're paying 25% APR on a rolling balance of, you know, several thousand or more dollars, it may not be the best time to start putting all of that extra cash into an investment if you're paying 25% APR on a high interest or on a credit card. So just taking a look at that and really assessing if it's the right time for you based on your situation. Of course, everyone's different, right? So another thing to consider is your debt to income ratio. You can also hear this referred to as your DTI, or debt versus income percentage, but it's basically just your monthly debt payment minimums divided by your gross monthly income. So Ryan, do you have any advice on kind of the percentages to look for there on DTI?
Yeah, I mean, I think under, you know, the 36, 40%, somewhere in there is a great range to be. Making sure that we have smart debt. You know, I like to think of your home loan as obviously something that's very difficult to save up for and pay cash for a home. So maybe looking at something that's, you know, that, and then maybe a small car loan, those are good. And then depending on, you know, your credit card situation, there's some great credit cards out there that have some points that can help earn cash back, but we want to make sure that we're trying to pay those off every month.
Yeah, absolutely. So the lower the better when it comes to your debt to income ratio. So, and then of course, we kind of talked about this already, but making sure that your interest rates are appropriate, right? You can always contact your creditors, discuss with them, you know, the interest rates you're currently paying, maybe see if you can get those lowered, or maybe your credit has improved since the last time you since you bought your house. Maybe looking at refinancing, or refinancing even an auto loan. So just something to look at as you are preparing to invest. But I'm going to move on because I know we want to spend most of our time today actually talking about investing. So can we start, Ryan, with just a simple definition? Tell us, what is investing, or what does it really mean to you? Yeah, take it away.
Yeah, great question. So to me, investing is exactly what it says, is taking money, putting it to work towards achieving a goal. The days of making money off of checking and savings are pretty much gone. Interest rates are at an all-time low. So we really want to put our money that's not our short-term need. We want to put that to work for us and see it grow. The checking and savings don't really have a lot of risk. The problem with those is, you know, they're not keeping up with inflation. So that's something that we want to be, you know, conscious of.
Yeah. And, you know, I do want to take a moment here and remind everyone that any investment not in a cash account, like a checking account or savings, any investment not in one of those will include some risk, right? And we'll review kind of the disclosures we need to talk about a little bit later. But there is always some risk of loss if you are doing investing. Of course, many different levels, right?
Exactly. So I think
go ahead.
Yeah. So really thinking about, you know, what our time frame is so important to starting the investment conversation. We really look at having that soonish 2 to 5 years. That's where we're going to get your conservative and moderate approaches to investing. And then your long term is going to be, you know, 6 years and beyond, you know, depending on maybe you're saving for a kid's college, or you're looking to, you know, just save for retirement. That's where we can actually take on some more risk and not worry about some of the bumps that come with investing in the short term.
Right, absolutely. Is there a minimum investment that you recommend?
Yeah, typically it takes about $1,000 to get an investment started here with Copper State Wealth Management.
That's what you recommend?
Yeah.
Good to know. Yeah. So that, there's definitely some things that you could invest when it's sooner, maybe a little bit more moderate, but of course that playing that long game can have some big rewards, but everything goes up and down, right?
Absolutely.
So if we're talking about how do you start, like honestly, when I hear the term investing, like start investing, it feels so overwhelming. So what does that really mean if we take a step back and we talk about what actually happens when you decide to start investing? Can you talk a little bit about that?
Yeah, great question. So really just setting an appointment with a financial advisor. We go through extensive training. A lot of us have been in some facet of the industry for a long time, so we're very experienced on the banking side, the investment side. Really just sitting down and looking at what your financial goals are. What are you saving for? I think that's such a key thing to think about. We also look at your overall financial situation, like you talked about earlier, making sure you've got a savings in place, making sure that your high interest rate debts are paid down first before we're going to look at investing, because we always want to do what's right for our members.
Right, absolutely.
Yeah. So the second thing that we're going to talk about when you sit down with a financial advisor is really looking at what your risk and reward tolerances are. So when we think of investing, there's always risk to seeing, your money fluctuate. So you could put in $1,000 and that money could go down to 900, or it could go back up to 1,100. It all depends on, what type of program you and your advisor decide is best for you and what your current situation is, as well as some of the things that are happening in the world. So really just taking a step back and making sure that you've got time. So if things are going down, you have time to let it recover.
Yeah. And you don't panic, right?
Exactly. And then it's really the advisor's job to help educate, our members on the specific programs that we're going into, any fees that are going to be associated with it. And then it's an ongoing relationship that we like to continue to build. We don't like to just do a transaction. We really want to build that long-term relationship.
Well, it sounds like, you use the information, that conversation you have about risk and reward and potential loss. It sounds like that information really informs you as an advisor and Tony and Anthony on which products to offer and explain and, kind of go forward with. Would you say that's the case?
Yeah, definitely. And like I said, every situation is going to be different. So really doing something that's catered specifically to what your needs are.
Yeah. Yeah, that makes sense. So, as we continue this conversation, we've talked about what is investing, how to start, kind of how to prepare. So the real information here is, Ryan, tell me exactly what I am investing in. What can you invest in? It seems like there are so many terms out there that are kind of, hard to understand. So can you just break it down for me into a couple of categories? And let's talk about really what you can invest in.
Of course. So we're going to start out with stocks. Stocks to me are the most exciting thing that we deal with. They have the most reward, but they also typically have the most risk to them. So a stock is when we're taking ownership or partial ownership in a company. So if we believe that a company's corporate profits are going to continue to grow, we want to have a piece of that, right? We want to be in on that growth. So the risk is, what if we're wrong? Last year was a big year for a company like Amazon that through the pandemic, a lot of people were ordering stuff from their homes because they weren't able to go out.
Right.
So their profits went way up. And if you were a stockholder in Amazon, you probably benefited from that.
So you're saying that people who already held the Amazon stock before COVID happened, like there's no way to know COVID was going to happen, right?
Right.
They just Amazon stock. And like Amazon was really popular before the pandemic too. Like it was doing great, but it really accelerated. So the people who had that stock already, what happened in that case?
Yeah, so they saw their money go up. So if you had $1,000 invested in Amazon, you saw it grow substantially over the last year. And, there's always going to be bumps along the way of a stock growing. The company's going to expand. They're going to make financial decisions. So, you really want to be a long-term investor when it comes to stocks. The more stocks that you have, the more diversified you are, the less risk you're going to have in that bucket.
But when it comes to stocks, that is investing in one particular company, right?
Exactly. So if you own, so that's where the big risk comes in, right? So if a company, I think back to 2008 when we had the financial crisis, one of my favorite places to go to was Circuit City. Well, through the financial crisis, Circuit City went out of business. So if you own stock in Circuit City or Washington Mutual, company I used to work for, they went out of business and your stock was gone. Your money was basically zero.
Wow.
Yeah. So that's where the risk lies. And that's where your advisor is going to do a great job to work with you on what types of risks you're comfortable with and making sure that we're getting you, in the right start. Another thing I like about stocks is stocks that pay a dividend. So a dividend is something that usually bigger, more established companies are going to pay out to you. And what we do is we take that dividend or income and we reinvest it to buy more shares. So if the markets are doing really, really well and you're making a lot of money on the stock price growing, you're also going to make money on the dividend that's coming in. Whereas if things are going down, we're reinvesting that dividend to purchase more shares, kind of like it's on sale. We're not paying necessarily what the full price would be. So that really helps us grow the account even faster.
Interesting. Okay. So you gave me the Amazon example. Is there an example of it kind of going a different way? Like if, I don't know, can you give us a different example?
Yeah. So thinking outside the box, we're going through the pandemic, right? So companies like J&J are going to see, their stocks bounce around because maybe there was some issues with, short term on the vaccines, where other companies, cardboard manufacturers are making more money because people are still shipping their stuff from home. So you really want to try and have different sectors of stocks.
Like you wouldn't want to be all in like transportation related companies,
Exactly.
They stopped traveling like with COVID, Of course, this is a very unique situation here with COVID. It's not always
exactly
quite like it, but it gives us some good things to talk about, right?
Exactly.
Okay, so I know you could probably keep talking about stocks, but I'm gonna rush us along here. And
okay. Yeah.
So the next category is bonds.
Yep.
What in the world is a bond? Because stock ownership, that's easy enough to understand. Okay, I buy it, I own part of the company, and I make money if they do well. Cool. I'm with you so far. Yep. Let's move on to bonds.
Yeah, so a bond is, they call it a fixed income instrument that represents a loan made by an investor that we're loaning money to, typically like corporations, we're loaning money to different governments. You can think of it as like an IOU between a lender and a borrower.
So how are we making money? How am I making money on a loan? I think of a loan as I'm paying out in interest. So how do I make money by investing in a bond? Yeah,
so instead of the credit union making the interest on it, you as the bondholder get paid the interest.
So it's like a flip.
Exactly. So that you're kind of pushing the credit union out on, them doing the loan, and you're getting the direct pay for it. So bonds, interest rates can always fluctuate. And I think where the biggest risk comes from bonds is you want to work with really good companies or governments around the world because you want to make sure that they're able to pay back that bond. Because if they don't, that's where the risk is at. That's where you can really lose money. Also with bonds, as interest rates are coming down, companies can refinance their interest rates and their bonds. So there's a lot of money to be made when rates are coming down. Now that we're in a really low interest rate environment, there's not as much money to be made in the bonds. And this is where having a financial advisor is so key. There's lots of different things that we can do on that sector to help make sure that we're protecting you from as interest rates go up. we got to be really careful on the bonds that we're owning in a portfolio.
That makes sense. Yeah. Wow, a lot of information. Can I ask you, so we've talked about stocks, we've talked about bonds, and those are more individual items. Let's move on to the, I guess, groups of things you can invest in, starting with ETFs. Tell me about ETFs.
Yeah, so an ETF is actually, we use a lot of acronyms in the financial industry. So it's going to be an exchange traded fund. So what that means is like the S&P 500 has 500 of the largest companies in the United States inside of it. So you also have, it's called EFA, it's EAFE, it's Europe, Asia, the Far East group of stocks. It's like a pool of stocks. So when we think of being an investor, if you buy a share of the S&P 500, you're going to own a small piece of all 500 of those companies. So you're going to have the risk that goes with all the companies, but you're also going to have the diversification that's really going to help protect you if some of those companies are struggling.
Yeah, instead of having it all in one. That makes sense.
Exactly.
So why do people like these? Why do people like ETFs? Like, what's the draw here to own, a little piece of 500 companies?
They're inexpensive. Okay. So I've always said in life, fees are only an issue in absence of value. So you're basically getting one of the lowest cost things you can do. There's really not management to it. You just own all the companies that are inside of it. So if the 500 companies are thriving, you're going to do great. If the 500 companies are really struggling, you're not going to do so great. This is where we find that, a lot of times not all 500 companies are going to go up or down at the same time. So really, leading into the next thing is, what are our options if we want to have some different choices just than investing in an index?
Yeah. So say, I don't want to own all 500. What is my other option to get like a group of different investments, I guess, in one pool?
Yeah, exactly. So especially when we deal with, like the closer to $1,000, $1,000 isn't going to get you 300 companies in the S&P 500, ownership. That's just not going to happen. So another way that we do that is through what's called mutual funds.
Okay. I'll pop the slide back up here. That's our fourth kind of what can you invest in thing we're going to talk about today.
Yeah, so I like mutual funds. They're probably one of the most exciting things that I personally deal with in combination with exchange traded funds and portfolios for clients. So it's basically, it's a group of managers that they are there to study how companies are doing, what their earnings are, what the bonds are doing, and they're gonna compare themselves to like an index. So if you are a mutual fund and you're trying to compete against the S&P 500, you want to make more money on it when things are good. And when things are bad and things are going down, you want to lose less money. So what that means is...
Isn't that what all of us want to do, right?
Yeah, exactly. So we're paying a little bit more expensive of a fee because we've got to pay for the management of the account.
For the people who are figuring out exactly how to make more money and lose less.
Exactly. So if we're going to give you a more consistent ride, you'll end up with more money at the end of the investment term. So I really like to break it down to where, say we're investing in and trying to compare against the S&P 500, there's lots of different sectors that can be in there. So airlines, transportation, you've got industrials and financials. All those different sectors do well in different periods of economic growth and contraction. You also have, maybe we only want to have 300 of the 500 companies. By doing that and by paying a little bit of a fee, you're going to have a hopefully a much smoother ride and more money at the end of the term.
Very interesting. So thank you for taking the time to go into each of those options. So I guess now the question is, how do we do it, right? Like, how do we invest? What are the ways we can invest? Can you just quickly kind of go through the different ways?
Yeah. So there's what's called dollar cost averaging. That's where we're doing like a systematic or automatic investment. of, maybe $50 or $100.
That's my dollars. That's considered dollar cost averaging.
Yes, exactly. So we've got different times you can do it. So some of my clients do it on a monthly basis. Some clients do it on a quarterly basis. Maybe they're just doing it once a year. The nice thing with dollar cost averaging is the market goes up and down through the year. So by buying throughout the year, you're buying at different price points. So you might be getting some on sale. You might be getting some a little bit more expensive when the markets are kind of at an all-time high like they are right now. But that consistency is really going to help you in the long term.
Got it. So, you're with a financial advisor, you can do dollar cost averaging. What if I'm like at the end of the year and I'm like, oh, I got some extra money. Like, should I just throw it all into an investment? Yes, no?
Depending on your time frame, absolutely. That's called a lump sum investment. So lump sum investments we are going to just dive right in towards reaching your financial goals. You have the risk that you're buying at the peak of the market and things are going to go down for the next few months. But because we did a great job and asked you the right questions, we know that you've got time on your side to let the money grow back. And by doing that, you're going to be completely okay. That the interest from the bonds, the dividends from the stocks are going to continue to reinvest and buy more shares of those mutual funds. And over the next few years, you'll really see a nice accumulation to the account.
Good to know. And that's definitely not something I would want to try to figure out on my own. So thank you for doing that job for me.
Yeah, that's a perfect lead in. So one of the ways is self-directed investing.
Okay.
So
in addition, if you are not working with a financial advisor, you could do self-directed.
Yeah, so that's where you're doing all your own research. You're having to open up your own account. You're doing all your buying and you're selling on your own. If you've got questions on what's going on in the economy, you're really just reaching out to the internet, maybe talking to friends who, might think they know what they're doing or know what's going on. So that's got a little bit more risk. It's great because it's inexpensive, but you get what you pay for. So, like if I'm going to have my vehicle break down, I'm going to call the mechanic. If I need, something done on my house, I'm going to call that trade that, works on that particular issue. And I'm going to have to pay them a little bit more to do it, but I know the job's going to get done right.
Yeah. Yeah, that makes sense. Unless you're like my husband who wants to do all of it himself.
Yeah, I do that sometimes.
All right. So let's talk about the last kind of way to invest, which is kind of newer. Tell us about micro investing. What is it?
Yeah, so micro investing is actually pretty exciting. So it's taken very small transactions, even pennies, and putting it into some kind of ETF or mutual fund. A lot of the online brokerage firms are having these ways to where, maybe you spend $9.17 on, whatever it is that you're buying, coffee. The remaining money, they round it up to put it in an account towards investing for your future. So that's an interesting way that you don't really notice that it's happening. But you can accumulate a significant amount of money by using your debit card.
It kind of sounds like dollar cost averaging on a very small scale.
Exactly.
Interesting.
Yeah, so it's really, really good.
I knew you were going to be talking about this, so I was kind of like doing some Googling, and I found that like there are some good things about it, like pros to micro investing. They're low minimums. Obviously, you don't have to invest $1,000 at a time in order to, use it. It's a low minimum. They're pretty simple, I think. I don't personally use it, but I've heard it's pretty simple, and that it can be low cost for some people. But on the other hand, a lot of times it's like a fixed fee, right, per month or per year. And if you aren't investing very much, that ends up being a way higher percentage of what you're investing than it would be if you were working with a financial advisor. So there's definitely pros and cons. And I think it's going to really depend on the person and what's going to fit best for them when it comes to choosing to do some micro investing or going with one of those other options. Would you agree with that?
Very well said.
So I think that covers mostly the ways to invest. And we've just got a couple more things to share today. And these are two key concepts to really make sure you understand before you start investing. But, you know, I do want to pause for a moment here. And I want to make sure that everyone is aware that securities, you know, what we're talking about today, securities are offered through Securities America Incorporated. They're a member of FINRA SIPC, and advisory services are offered through PFG Advisors. Just so you know, Copper State Wealth Management, Copper State Credit Union, Securities America, and PFG Advisors are all separate entities. So Securities America and its representatives do not provide tax or legal advice. And the funds that are invested, those investments are not NCUA insured. There's no credit union guarantee, and they may lose value, as we've discussed today. So just wanted to make sure we shared that. And now let's get into our last little bit here, our last couple of minutes, which is key concepts to understand before you start investing. So, you know, we talked about this and you said there's two things that I really would want to make sure people understand when they get into the investing world. The first one is diversifying, or having diversity
Right.
in your investment. So you gave me a really fun example, Ryan, about the Empire State Building. Can you share that with everybody?
Yeah. So if we keep it really simple, picture you're on the 100th floor of the Empire State Building and you're in an elevator and you got one cord holding you up. If that cord gets cut, you're falling all the way to the bottom. Now, I don't know about you, but I think if you're going to go down 100 stories without anything holding you up, you're going to crash and burn. It's not going to be great. But if you attach 100 cords to that elevator and something happens to one of those cords, you might feel a little bit of a shake. You might know something's not right, but you're going to be protected. You're going to be safe. So the idea of diversification through mutual funds, through ETFs, through some of the other programs that we have, that I'm sure we'll be talking about later, those are really going to help protect you from the scary situations of, oh my gosh, I invested in this and I lost all my money.
Yeah.
We don't want to do that for you.
It's not like you can eliminate every single risk, right? There's still going to be those blips, those up and downs, but it's not like you're falling 100 stories. So
yes, exactly. So you're not going from having $1,000 to having zero.
Yeah, very interesting. So, and when it comes to fees, really, it sounds like each product is going to have fees. So everything is going to have some sort of fee, right?
Of course. And that's where we really want to disclose to our members and our clients of, you know, what those fees are and why we charge those fees. So there's external fees for mutual funds, also internal fees. There's advisory fees for some of the different types of accounts that we offer. You're paying a fee for advice. You are paying a fee for, you know, hey, I'm going to call you every quarter and talk to you about what's going on in your account and making sure that we're on track to meet your goals. So there's a small fee for that. And when the markets are going down and you're scared, you're nervous, you're going to pick up the phone, you're going to call me, and we're either going to answer the phone and we're going to talk it through, or maybe you're going to leave a voicemail and I'm going to have to call you back. But that's what you're keeping us for, is to make sure that we can get you through some of the bumps.
And it sounds like to avoid like Googling and going down the rabbit hole on Google about what you should or shouldn't be doing.
Exactly. And it's so important to have a relationship with an advisor that you trust. I think that's just number one. Looking at some of the different types of fees, with external fees, that's usually through like a mutual fund. And then the internal fee continues to pay that manager to continue to watch the companies for you, to make sure that, you know, as the economy's changing, that we're doing the appropriate buying and selling to help protect you while still trying to definitely make you some money over time. And then, you know, with the advisor relationships, typically you're going to have all stocks, bonds, mutual funds, and those ETFs that we talked about. So, you know, really the advisory accounts give us a lot of diversity to help protect the account.
Yeah, well, awesome. I should have been telling everybody throughout the session to please send over any questions that you may have. We would love to hear from you. But yeah, that is the bulk of what we wanted to talk about today. If you have any questions, please go ahead and type those in the Q&A box down at the bottom. And you will be seeing an email. It's going to come your way. It's going to have the survey, as well as a free download. It's called How Stocks Work. So we just kind of honed in on one specific area we talked about today, the stocks. And it's a really interesting infographic. You will get that after you complete the survey. You should see that email coming over shortly with that information. And then when the recording is ready, we will also share that recording with you. It'll be up on our website. You'll be able to read through the transcript, kind of review anything that you may have missed the first time around. I know it was quite a bit of information. Ryan, anything to add here at the end? Anything you want to share before we sign off?
Yeah, I just wanted to get my contact information out there. I'm Ryan Graham with Securities America and the credit union as well. Phone number to reach me at is area code 623-580-6070. And if you guys have any questions on what we've talked about today, I'm more than happy to set up a meeting with you and discuss what your options are, and just to make sure that we're giving you the education that you're looking for.
Yeah, Copper State Wealth Management is here for that exact purpose. The financial advisor is Ryan Graham. We also have Tony Diastis and Anthony Rocha, and they are at a variety of branches around the valley. But their focus is on helping with this kind of stuff. So if it feels overwhelming, you want to talk more, please look them up. Their website is copperstatewm.com. And it looks like I don't see any questions that have come over so far. So I think I will pause here for today. Thank you so much, Ryan, for coming on this afternoon and giving us all of your knowledge. We really appreciate it.
Thank you for having me.
And we'll talk to you next time.